What are dividend stocks? A dividend stock is a kind of stock that offers two wealth-building possibilities. When you have a dividend stock, you can create an income with dividend payments. Furthermore, the stock's value may increase with time to boost your net worth. Basically, any stock could be a dividend stock if it gives a segment of the company earnings to its shareholders by using dividends. What is a dividend? So, what exactly is a dividend, you may ask? It's important to know precisely what a dividend is in order to better understand what this kind of stock can offer. Here's a definition according to the U.S. Securities and Exchange Commission. A dividend is a portion of a company's profit paid out to its shareholders. A public company can decide to pay dividends on a routine schedule to its shareholders. Having said that, the company can give out dividends or do away with dividends at any moment. For instance, let's pretend you have 100 shares in a particular company that pays out a dividend of 10 cents for each share. Because you're an investor with 100 shares, you would be given $10 in cash. In contrast to a bond, a company is not legally forced to offer consistent dividends to its shareholders. With that being said, there is a danger that a company could remove or decrease the possibility of dividends at any moment. Before I tell you how to start investing in dividend stocks and share some important measurements that you need to know, please give this video a thumbs up and subscribe and click the bell because it really does help out the channel and I appreciate it. Also, be sure to stay until the very end of the video where I'll tell you exactly why high yield isn't everything and how to avoid falling into the dangerous yield trap. And before you make any decisions with your finances, please seek out professional and expert help. How do dividend stocks function? Dividend stocks can be used to develop long-term wealth or produce a cash flow right away. Both of these are important to a maintainable financial investment. The mix of the stock price and paid dividends is referred to as the total return. Many investors delight in the income-producing quality of dividend stocks, despite the fact that the dividends aren't an absolute guarantee. However, it is necessary to look at the increase of the stock prices at the same time. If you are a dividend stocks investor, you might get dividends from the company according to the amount of shares you have. Usually, dividends are paid every 3 months by means of the shareholder's brokerage account. However, each and every company will establish the payment schedule and payment method on an individual degree. How to start investing in dividend stocks. Number 1, research and study companies that provide dividends. As you begin your hunt for the best company to invest in, you'll notice that lots of companies don't provide dividends whatsoever. With that said, you can immediately scratch those companies off the list. Typically, you'll need to search for well-established companies with a track record for financial stability and routine dividend payouts. Even though a history of routine dividend payments is not necessarily a promise of any future payments, it can suggest a more dependable investment. As you examine the investment possibilities with a company, think about the following signs of success. First of all, think of the company's performance history. You need to invest in a company that has an extensive background of success. Secondly, you need to think about debt. Even though a number of companies can take advantage of debt in a suitable way, excessive debt is not a good idea. With excessive debt going on, the company can be required to use earnings to take care of that debt rather than paying out the dividends you're looking for. And third, look at the stock price. Take into account if the stock price is a correct representation of the company's value. And lastly, take a look at the financial statements of a company. Before you continue with an investment, take a look at the company's financial statements. Make certain that the company is financially stable with an expectation for expansion and growth prior to you investing. Number 2, open up a brokerage account. You can get your investments into dividend stocks with a brokerage account. By having the best brokerage account in effect, you can purchase your dividend stocks. As you search for a brokerage account, look for a platform that reduces costs and provides you lots of investment possibilities. Number 3, reinvest through DRIP programs. When you begin purchasing dividend stocks, you can start spending your brand new income stream immediately. On the other hand, you can also use this new income and reinvest it back into the company and keep on growing your financial investments. You can simplify the reinvestment process by using a DRIP program, also referred to as a dividend reinvestment plan. This is a straightforward solution to reinvesting your dividends on a consistent routine. Number 4, don't ignore dividend stock funds. Looking into individual dividend stocks may take up a lot of your time. Fortunately, there is an alternative offered with the aid of dividend stock funds. Rather than shelling out all of your time analyzing individual companies, you can look for an individual stock fund that fits your financial investment objectives and your risk tolerance. Number 5, don't forget about taxes. As you work hard trying to create this brand new income stream, remember to include taxes into your budget plan, or else you may be getting a disastrous shock around tax time. In many cases, dividend stocks pay qualified dividends. Counting on your current tax bracket and various other income sources, this income might be taxed anywhere from 0 to 20%. Spend some time to figure out just how much you should set aside from your dividend payments to pay for your tax bill when the time comes. Number 6, important measurements you should know. Prior to you purchasing any dividend stocks, it is essential to learn how to analyze them. These 6 measurements can assist you in recognizing how much in dividends to anticipate, how dependable a dividend may be, and most significantly, how to look for red flags. Number 1, total return. This term refers to the rise in stock price, referred to as capital gains, plus dividends paid. For instance, if you spend $10 for a stock that grows in value by $1 and pays out a 50-cent dividend, then the $1.50 you've acquired is equal to a 15% total return. Number 2, dividend yield. This is the annualized dividend shown as a percentage or portion of the stock price. For example, if a company pays $1 in annualized dividends, and let's say the stock costs $20 for each share, then the dividend yield would be 5%. Yield could be useful as a valuation measurement by comparing and contrasting a stock's recent yield to historic levels, and it's also helpful in recognizing warning signs. All other factors being equal, a higher dividend yield is much better. However, a company's ability to sustain the dividend payout and ideally increase it matters much more. Number 3, cash dividend payout ratio. This term is the dividend shown as a percentage or portion of a company's operating cash flows minus capital expenditures. This measurement matters due to the fact that GAAP net income is not a cash measurement, and several non-cash costs can cause a company's revenues and its actual cash flows from its functions to differ considerably from one moment to the next. This irregularity can make a company's payout ratio deceiving sometimes. Investors can utilize the cash dividend payout ratio together with the simple payout ratio to much better comprehend a dividend's sustainability. Number 4, payout ratio. This term refers to the dividend as a percentage or portion of a company's revenues. If a company makes $1 for each share in net income and then pays out a 50 cents per share dividend, then this means the payout ratio is 50%. The lower the payout ratio number, typically the more sustainable a dividend ought to be. Number 5, EPS. This stands for earnings per share. The EPS measurement normalizes a company's revenues to the per share value. The companies that have demonstrated the capability to routinely increase earnings for each share as time goes on and therefore raise their dividend are the very best dividend stocks. A past history of earning progress is often proof of long-lasting competitive advantages and strengths. And number 6, PE ratio. This stands for the price to earnings ratio. The PE ratio is computed by dividing a company's share price by its earnings per share. This PE ratio is a measurement that could be utilized together with dividend yield to figure out if a dividend stock is reasonably valued. Before I tell you exactly why high yield isn't everything and how to avoid falling into the yield trap, please give this video a thumbs up and subscribe and click the bell, because it really does help out the channel and I appreciate it. Also, type the word yes in the comments below if you want to invest in dividend stocks. Why high yield is not everything. Newbie dividend investors typically make the error of purchasing stocks with the highest possible dividend yields. Although high yield stocks aren't necessarily a bad thing, high yields are usually due to a stock's price dropping because of the risk of the dividend being cut. And that is a dividend yield trap. Here are the top 5 actions you can use to stop yourself from falling for that yield trap. Number 1. Make use of a company's dividend record of both payout growth as well as yield as a quick guide. Number 2. Stay clear of purchasing stocks depending entirely on dividend yield. If a company has a considerably higher yield than its competitors, that's usually an indicator of some trouble rather than opportunities. Number 3. Utilize the payout ratio to measure a dividend's sustainability. Number 4. Take into consideration the industry and company in itself. Is the company's business in danger from poor demand, the competition, or any other disturbance? Number 5. Research and study the balance sheet, including things like cash, debt, and other liabilities and assets. Unfortunately, if there's a yield that appears too good to be true, typically it is. It's much better to purchase a dividend stock with a lesser yield that's solid than to go after a high yield that might end up being only an illusion. Additionally, concentrating on dividend growth, a company's past history and capability to increase its stock dividend, often turns out much more financially rewarding. Click the video on the screen to learn all about dollar cost averaging and how to use it to build wealth.